Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi guys, this is Aditya Vora here. Hope all of you are doing good in this volatile market. Right from my college days to studying for chartered accountancy, we were always taught about certain gospels in investing and how they work in life. Some of you might have heard it from family members and elders, while some of you might have studied it in economics and finance. When you enter the real world of business and investing, most of the bookish concepts are far from reality. The main reason is that they are designed for an ideal world which doesn't have anomalies like geopolitics and cross-country currency transactions and so on and so forth. So friends, in this video, I am going to talk about two myths which we have been taught but don't hold true in the real world, especially in the post-COVID world. To start with, let us talk about an asset which all of us, especially in India, love to buy when it comes to the so-called concept of being safe. Yes, I am talking about the yellow metal, that is gold, and the biggest myth that gold is a hedge against inflation. I am sure you must have read yesterday's headlines on the United States consumer price inflation data, which grew by a massive 9.1% in June. This 9.1% number was above all estimates. Makes me feel proud and want to thank the Reserve Bank of India for not doing anything irrational during the past 2 years. Well, if you look at the Fed actions over the past 2 years, just shows how stupid these people were in printing endless amount of money and mounting debt. There was a time in 2010 when India had an inflation rate of 11%, while USA had an inflation rate of 1.5%. And look how the tables have turned and how. I mean, when was the last time you saw US inflation at 9.1% and India's inflation at 7%? Anyways, in this case, if you follow the textbook of investing, I am sure you would have bought gold in tons to hedge against inflation. After all, gold is a hedge against inflation, right? We Indians love gold and ignore statistics. After all, we have been hearing this since ages that kharab time mein gold hi kaam aata hai. Hindi movies glorify it, and when they say the household jewelry was sold during bad times. Let us look at what happened to inflation and gold from a short term, that is a 1 year perspective, and over the long term, how gold has behaved. US inflation exactly a year ago in July 21 was at 5.4%, while gold was trading at $1825. Over the next 1 year, inflation started going up as commodities skyrocketed. As per economics, gold should have surged too, as it is technically a hedge against inflation. Well, in the past 1 year, inflation has surged to 9.1% from 5.4%, while gold has fallen by almost 5% to $1744 an ounce. A lot of you would tell me that I am missing out on the interest rate factor also, as clearly the US Fed was behind the curve in raising interest rates. However, over the past 6 months, the Fed has increased its interest rates by 1%, and still there was no reaction from gold despite the surging inflation. In today's post-COVID world, there is a clear rewriting of rules where inflation and gold don't have material correlation. For all the gold enthusiasts, let us also look at how erratic and tepid returns of gold have been. With a 5.7% CAGR in rupee terms over the past 10 years, gold has turned out to be last decade's underperformer, while on the other hand, in a stark contrast, Nifty has delivered 15.5% CAGR over the past decade. I am sure this is common knowledge that stocks outperform gold, but the point I am trying to make is about consistency. Gold returns are erratic and in spurts while stock market returns are relatively consistent. Let me give you an example. In 2007, India's first gold ETF was launched. You will be astonished that from March 2007 to January 2012, the ETF returns were 23.8% compounded. Yes, 23.8% compounded. However, post that, gold went into a deep slumber. The point I am trying to make is that gold is not a safe haven anymore, and to make money in gold, you really need to time your entry and exit. Not only it is not a hedge on inflation, but moves in spurts and is erratic. So now let's talk about the relation of commodity prices, inflation and stock markets. Another paradox. Everyone you meet in the stock market will tell you that the problem why the markets are not going up is inflation, which is due to higher commodity prices. I agree this is a fact when it comes to Indian markets, as we are commodity consumers and definitely not producers. So let's listen to this paradox carefully. When you say that commodity is a problem, especially oil, and now that the prices of commodities are going down, the main problem of inflation is getting solved, isn't it? So in that case, the market should go up. Let's look at this paradox in a different way. Stock markets run on earnings growth, and from 2014 to 2020, inflation was on a downward trajectory, but there was no earnings growth despite low inflation. And that is precisely the reason why stock markets gave very moderate returns. In fact, moderate inflation leads to higher earnings growth, which is what we exactly saw over the past 2 years. The only way commodity prices go lower is when interest rates rise and dollar becomes strong, which is the case at present. However, with rising interest rates and a weak currency against a dollar, with India being a net importer, how will earnings growth pan out in a positive way? Quite a paradox, isn't it? Well, the more you think, the more you get confused. On one side, we want lower commodity prices, but in the present scenario, commodity prices go lower as interest rates rise. Also, when interest rates rise, the dollar becomes stronger, which is a problem for India and earnings growth for the company. That's why they say in movies, always think what you wish for. So friends, these were my views on why I think gold is a bad investment and definitely not a hedge against inflation. I have also highlighted the paradox in the Indian stock market about commodity prices and the impact of interest rates on earnings cycle, because at the end of the day, the only thing which moves the stock market is earnings, earnings and only earnings. So thank you for watching my video and I hope you found it insightful. I have tried my best to quell all the myths which are present in the current scenario. Let me know how the video was and what your views are. Thank you.